Today, we are diving into something that is all over the finance internet right now. What stocks are overhyped and what stocks are ready to explode? And we're going to take 6 stocks, run them through the only filter that truly matters to us, valuation. This process will tell us which of these stocks could be potential buys at the right price and which ones are better off to avoid altogether, because great companies do not automatically make great investments. It all comes down to the price you pay. First stock we're going to analyze is Hims. This is getting a lot of attention lately. I hear it a lot in the community when we do live streams. I get a lot of requests for Hims. It is down almost 6% today alone. This is a company that lets you order things like hair loss treatment, weight loss medication, and even therapy straight to your door. No doctor's office needed. In 2025, the stock was one of the hottest on Wall Street. Now, in early 2026, it has dropped more than 50%. So what happened? Is this an overhyped stock that's a sinking ship, or is it a buying opportunity? Here's the problem. A big part of Hims' growth came from selling cheaper versions of popular weight loss drugs. But in February of 2026, the FDA stepped in and called those cheaper versions illegal copies. On top of that, NVO, Novo Nordisk, the company that makes the real drug, is now suing Hims. And to make things worse, big pharmaceutical companies are now selling directly to consumers, cutting Hims out of the picture. That's why the stock fell so hard. And that's why a lot of investors are betting that it's going to continue falling. But here's the flip side of the story. About 70% of Hims' business has nothing to do with weight loss. Skincare, mental health, and men's health products are all growing and making real money for the company. The company also has over $1 billion in cash, so it's probably not likely that they're going to go broke anytime soon. They're expanding into new countries like Australia, the UK, and Germany, which could add over $200 million in new revenue this year alone. And they're building a model around personalized treatment plans, something that's very hard for big drug companies to copy. So, is Hims a falling knife or a real opportunity? Well, that really comes down to whether you think they can fight through this legal storm and keep growing what's already working. So let's go analyze the stock now, take all of these factors into consideration for our margin of safety as we make our stock analyzer assumptions. So, Hims is a $3.86 billion company. Like we said, year to date, down 53.5%. But remember, just because it's down a lot doesn't mean it's a buy. It means it's cheaper, doesn't mean it's cheap, but it still grabs our attention. $3.86 billion market cap, $4.88 billion enterprise value. Now, the issue we have is the free cash flow ain't great. $120 million last year and $46 million a year for the last 5 years, selling for 32 times last year's free cash flow. Okay, so remember, just because it is selling for a high multiple of free cash flow doesn't make it expensive. This company has a lot of growth potential. It generated $2.21 billion in the last 12 months in revenue. What's that market size for them? Can they grow? Can they 10x? If you had 2 companies that were selling for 32 times free cash flow, one was going to grow 30% a year and one would grow 10% a year, which one deserves a higher premium? Clearly the one growing 30% per year. That's the way I want you thinking, okay? No dividend here. Profit margin last year was 6% versus 0.64% in the last 5 years. But look at this, guys. Gross margin of 75%. That's high. That's a high gross margin. That means they can really drive a lot of profit and free cash flow as they increase their revenue. All right. 5-year return on capital is negative, but 1 year is positive. I'm willing to bet they probably dilute the hell out of their shareholders. Let's look and see. Yes. So guys, these are 8 pillars. Cash flow's up. Net income's up. Revenue's up. Lots of debt relative to free cash flow. High multiples. And diluting shareholders. 24% more shares today than 5 years ago. This is the silent killer in investing. So even if this company's right, if they keep diluting you, you won't get as much of the upside. Now, guys, I've gone through a lot of stats here. We're going to do that in the next 5 companies. If it feels overwhelming, you're not alone. At some point in history, every single person who's a good investor was overwhelmed. We're here to simplify this as much as possible. So if you want a simple easy way for all of this to be explained to you, I made it very easy. Click the link below, absolutely free PDF that'll explain all these key metrics to you, how they're calculated, what they mean. That way you have that cheat sheet in front of you as you go look at companies, and we can speak the same language as you watch more and more of our videos. And just remember, we're very big to talk about this. Never buy stock because anybody in the world, even Warren Buffett, owns it. We're here to teach a process that you can apply to your own stock picking. The purpose of this video is to teach you how to value stock so you can make your own confident decisions as an investor. And if you're new here, welcome. You're going to hear me show you things and say things you've never heard on YouTube before. That's really important for me. That is why, the exact reason why I teach on YouTube. So let's go see what analysts think about this company. Well, some big growth here, 60 cents growing to $1.90, but not a lot of analysts here reporting on it, with revenue growing 18, 19, 5%, 18. It's all over the board. Guys, I'm not going to lie to you. Before we get the stock analyzer to run the numbers, this is a company that is a little too new for me. If you told me 5 years from now Hims didn't exist, I'd be like, yeah, it makes sense. If you told me 5 years from now Hims was 10 times bigger, I'd be like, yeah, that makes sense. I don't know where, that's not my kind of investment. But for the right person, this is a perfect investment. It might be selling cheap enough. Remember, if you have a 10% chance of a 50x payoff, you take that every single time. If you have a 10% chance at doubling your money, you never take that. That's what investing is. It's about understanding your probabilities and understanding that when you look at a company, if it's cheap enough, the juice may be worth the squeeze. So that's what we have to figure out here with our stock analyzer tool. So when was the last time I did Hims? I'm going to pull this bad boy up right now. I did Hims just a few months ago. I did revenue growth for the next 10 years of 8, 12.5, and 20% revenue growth. I did profit margin of 10, 17.5, and 25, and basically driven that by the fact that, yeah, they haven't done it yet, but with 75% gross margin, I don't think it's unreasonable for them to hit these kind of numbers. PE, 10 years from now, I put 16, 19, and 22, and a 9% no margin of safety return. I'm going to do that on all the stocks we do. I'm doing it to show this is what I think the company is worth based on the market returns and based on these assumptions. Now, if you don't agree with these assumptions, go to the stock analyzer tool, put your own assumptions in, and by all means, that's the art of investing. I hit the analyze button. The stock's currently at 15 bucks. Okay. Low side is 20, high side is 160. So this might be, in the middle side is 57. The juice may be worth the squeeze here. You're looking at, if you think my low assumptions are egregious, that's pretty good return for egregiously low assumptions. A lot of potential here. The question is, for you, is the juice worth the squeeze? Now, most investors lose money because they're obsessed with picking some gigantic winner. But the best investors think differently. They focus on eliminating losers first. That's what we're doing here when we analyze a stock. Now, that doesn't mean anything about the stocks we're picking today, but it's really important to understand that. Second stock, SanDisk, SNDK. Boom. Let's pull it up right here. Memory semiconductors. They're down 6% today, but we're on a very red day today. All-time high of $725 just a month ago. 52-week low, $27, 1 year ago. Incredible. This is the 1-year chart. This looks like other companies' 40-year charts. This is the 1-year chart. Guys, this is a company that makes memory chips that store data inside computers, phones, and increasingly now, the giant AI data centers you hear so much about. They were spun off of Western Digital, and the stock went on one of the most incredible runs you'll ever see, rising over 1,000% in the last 12 months. Guys, if that doesn't turn your head, I don't know what will. But as an investor, it raises a simple question. Is this the real deal, or has the stock gotten away and way ahead of itself? Here's the case for being careful. A stock that goes up 1,000% in a year is priced for absolutely everything to go right, and that's a risky place to be. The memory chip business is famous for boom and bust cycles. Right now, demand is sky high. But if manufacturers start building too many chips too fast, prices can crash just as quickly as they rose because of oversupply. On top of that, competitors like Samsung could flood the market with their own chips or come out with better technology, which would squeeze SanDisk's ability to charge premium prices. When a stock is this hot, Even a small piece of bad news like earnings that are good but not good enough can send it tumbling. But here's why the bulls aren't wrong either. AI data centers are consuming memory chips at a pace the world has never seen before. And right now, there simply aren't enough chips to go around. Several reports suggest that SanDisk's manufacturing capacity is essentially sold out for all of 2026, which gives them serious pricing power. Some analysts are projecting earnings to grow over 800% this year alone, and even after the massive rally, a handful of analysts still consider the valuation reasonable when stacked up against that kind of earnings growth. The company is also locking in a multi-year contract with many customers, which is going to smooth out some of the boom and bust risk that historically burned memory chip investors. So, where does that leave you and I? Well, the bull case says SanDisk could hit $1,000 per share if the AI boom keeps rolling. The bear case says a 30% or more drop is very possible if the cycle turns. This is a stock with real momentum behind it, but also real risk baked into that price. So, just like we analyze HIMS, we're going to now analyze SanDisk with the same process we talked about before. And remember, if you downloaded the PDF, walk with me through it. Market cap, $90 billion, generated $1.45 billion in free cash flow. That means it's selling for 63 times free cash flow. But guys, if their earnings go up 800%, here's the point I'm going to make. If God came down right now and said, Paul, SanDisk earnings are going to go up 800%, their cash flow is going to go 800% this year, and it's a permanent plateau, and they're going to grow 10 or 15% from there, this is the cheapest thing on the market right now. Well, maybe not the cheapest thing, but it's very cheap. That's the point I want you thinking. I want you thinking about what makes this cheap right now. What has to happen? That's why we put things together in the stock analyzer tool. Guys, gross margin here, 35%, nothing to write home about. But will that go up as demand increases? Yes. But again, if demand or supply is too out of sync, this could drop too. And their profit margin hasn't exactly been very admirable as of late. Interesting enough, their free cash flow way higher than net income, and their 5-year free cash flow way higher than the 5-year net income. This is a doozy. Return on capital is crap. Let's go check out their finance. I actually, one of the few times that I check out their financials. I mean, look at this. The company was essentially stagnant for how long? The revenue was stagnant. So the question becomes, are we getting to a new place of chips where this is going to be a leader, where they're going to just go for a long time? Even if it's only 10 or 15% growth for a long time, for 10 or 15 years, that's enough. Let's go see what analysts think. Well, let's go to 8 pillars first. All right, some checks, some X's, 4 and 4. Oh boy, net income's down. They have been buying back shares. Let's see when they bought those back. We go to them down here. They've been buying back shares. They bought back shares right here. A big buyback. Right there to 145. Now they've issued a few more shares. Wonder what that was. Did they sell off a division? Or was it when they were spun off? I don't know. Analyst estimates. Oh my God, look at this. Essentially the same earnings, according to analysts, over the next 4 or 5 years. And revenue. This might be the too hard pile again. Let's see what SanDisk can do. Have I ever done it before? Never. Popping our cherries here, guys. Okay. I'm going to go with 5, 12.5, and 20% revenue growth. Big, wide margins here. Big, wide assumptions here. Profit margin. I'm going to go with 8, 14, and 20. Seems high with only a 34% gross margin, but we'll stick to it because look at their free cash flow. PE. Returns on capital were double digits before 10 years before. So I'm going to go with 14, 17, and 20. 14, 17, and 20. And my 9% no margin of safety return. Analyze button. Yeah. 78 in the low side, 770 in the high side, 270 in the middle. So essentially a negative return, even a negative return based on my assumptions. But again, maybe my assumptions are wrong. We don't exactly know what the right number is. So before we go any further, I want to make one thing very clear. This video is not a standalone video. It's part of a great journey that we go through every single month together on this channel and all year long. We are consistently digging through the market to find what we hope are mispriced stocks to identify opportunities and avoid the overpriced junk out there. To get the full picture, you need to follow the entire process, not just one video. So make sure you're subscribed and watching every video, because this is a journey we're taking together, and I assure you, as you embed this in your brain, it'll get better and better. Now, our third stock is one that I actually own. And again, don't ever buy a company because I or anybody else, even Warren Buffett, owns it. It is Target, who actually just reported today and did well. And guys, if you'd asked me 3 hours ago what I thought Target's price was, I was gonna say, I don't know, 85 or 90 bucks. I don't pay attention to my stocks. Target is one of the most recognizable retail brands in America. And after a rough few years of falling sales and frustrated investors, the stock may be showing signs of life. In early 2026, Target shares have jumped now over 20% as investors started believing that a major turnaround could be coming. The excitement centers around a new CEO named Michael Fidelki and an aggressive plan to spend $5 billion in 2026 alone to modernize the business from the ground up. So, why are investors suddenly optimistic? Well, for starters, the stock got beat up badly in 2025, which actually made it look attractive from a value standpoint. It was trading at a low price relative to its earnings. It was paying out a dividend, for those who love dividends, of over 4%, meaning investors were getting paid just to hold the stock while they waited for other things to improve. On top of that, Target started showing some early wins. AI-powered tools helped keep popular items in stock more consistently. Same-day delivery grew by over 35%. And their Target Circle 360 membership program was bringing customers back even more frequently. Here's what the turnaround plan actually looks like. They're planning to open around 30 new stores in 2026 as part of a bigger 10-year plan to build 300 new locations. They're also redesigning existing stores with major updates to departments like home, baby, and beauty. They're leaning hard into their private label brands like Good & Gather, Cat & Jack, and Threshold, which are products they make themselves and keep more of the profit on. They're rolling out ChatGPT-powered shopping tool to make the online experience feel much more personal and easier to navigate. When the Ulta Beauty partnership ends in August of 2026, Target's also planning to expand its own beauty section with new independent brands to fill that gap. The overall picture that analysts are painting is cautiously optimistic. They're expecting modest sales growth around 2% and earnings per share to rise about 5 or 6% in 2026, helping along by cost-cutting measures, including the elimination of 1,800 corporate positions. Guys, we're not just going to take analysts' words for it. We're going to make reasonable assumptions with the stock analyzer tool so we can determine the right price to pay. So, it's a $53 billion company, a lot of debt, leases, free cash flow, $3 billion a year, pretty consistent with their 5-year number. They pay out this 4% dividend that eats up 2/3 of their free cash flow. So with their plans to expand and spend $5 billion, it's kind of like, guys, what are you doing about this dividend? I wouldn't be absolutely shocked they dropped it, but maybe they keep it just to keep investors happy. Our community has it as a buy rating overall. 8 pillars, 5 checks, 3 X's. Debt's high, doesn't worry me so much because of leases. Cash flow is down significantly, and so is net income. They have those issues. Remember, even a business that's steady or declining still has value. According to analysts, though, they have growth here. 6, 7, 7, 13.5, and 16% earnings per share growth for the next 5 years. Revenue growth, 2%, 3%, 3.5, 3, 3.5. Nothing to write home about, but you can make a lot of money with that kind of growth if you pay the right price. So let's pull it up in Stock Analyzer tool, where this is where we put the numbers and the story together. The last time I did Target, right here, 10-year assumptions, 2, 3, 4% revenue growth, 3, 4, and 5% profit margin and free cash flow margin, a future PE of 17, 20, and 23 with high returns on capital, a great brand awareness, women love it, and finally a 9% desired return. I hit the analyze button. I have made every possible investing mistake you can imagine. I bought too high, I sold too early, I listened to the wrong people, and that's exactly why I built Everything Money. It was first built purely for me. I wanted the tools that gave me clarity and decreased the fear of investing. People saw me using these tools on YouTube and said, Paul, can you share those? And at first I said, no, it's a data feed. But then I realized I could make this. So I did. And the real community was born. Real people sharing ideas, live chats, live streams, and tools that help you beat 99% of investors, but most importantly, help you sleep better at night because money can be very scary. I still use these tools every single day, like Stock Analyzer, Real Estate Calculator. So stop guessing, start learning, start sleeping better. Try it for $7 for 7 days. I'll see you in there. And here are my prices. A low price of 106, high price of 250, middle price of 168. Not some great numbers on my assumptions above, and still a lot of green here. And as you saw, when it hit its 52-week low of $82, that was selling for almost a 20% discount to my base case here. Pretty incredible. Now, our fourth stock. This is a stock that probably nobody's ever heard of. It's called Tesla. Now, let's go look at Tesla. This is obviously one of the most talked about stocks in the world, so I was joking. And depending on who you ask, it's either a visionary company that will reshape the future or a wildly overpriced car company that investors have fallen in love with for the wrong reasons. It is literally split that much. So as early 2026, the stock has bounced back from its 2025 lows, but the debate over whether it deserves its price tag is louder than ever. Here's the honest case for being cautious. Tesla's stock trades at a price to earnings ratio that has at times exceeded 300, meaning investors are paying an enormous premium compared to what the company is actually earning today. Meanwhile, the core business of, I know this is going to trigger a lot of people, selling cars is under real pressure. Deliveries dropped 16% in the final quarter of 2025, and Tesla has lost its spot as the world's top electric vehicle seller to Chinese competitor BYD. In fact, Tesla's car lineup in some markets is starting to feel outdated. The federal EV tax credit in the US was eliminated in late 2025, which dampened demand. And Elon Musk's increasingly polarizing public presence has become a genuine concern for the brand because the libs hate his politics. They loved him when they thought he was a super lib. They hated him the second they realized he wasn't. So when you strip away the future promises, the actual car business right now seems to be shrinking, not growing. Now, that's short term. Good turnaround. The biggest bet Tesla has been making is on its full self-driving technology. Does this sound like an echo from 2022? Tesla plans to expand its robotaxi service to 10 major cities, rolling out a dedicated driverless car called the Cybercab, and shifting its full self-driving software to a subscription model that would generate steady, high-margin revenue month after month. But Tesla's believers aren't really investing in a car company anymore. They're investing in what Tesla says it's becoming. The company's pouring $20 billion into its business in 2026 with a message that it wants to be thought of as an artificial intelligence and robotics company. Tesla has started manufacturing humanoid robots, which I'm a huge fan of, called Optimus, for use inside its own factories with plans to eventually sell them externally. Guys, I will buy 85 of these things to make my life easier. So the bottom line is this. If you buy a Tesla stock today, you're not really betting on cars. You're betting that the robotaxis, humanoid robots, and AI software become massive businesses within the next few years. That might happen. But those are big, unproven bets. And the stock is already priced like they're going to work. That combination of high expectations and unproven technology is exactly what makes Tesla one of the most exciting and massively overhyped stocks you can own right now. So, a car company that does $95 billion in revenue and is worth 1.39 is selling for 15 times sales. The average car company sells for 0.5 to 1 time sales. The average software business, remember, people say this is a software or robotics business. Microsoft sells for, I think, 12 times sales. So Tesla's selling for higher than Microsoft. Does Tesla have more potential than Microsoft? Theoretically. But 1.4 trillion, that's a lot of price to pay for 94 billion in revenue with a gross margin of 18%. That sounds overwhelming. Guys, the gross margin on Microsoft is 70%. The gross margin on Oracle, 60%. The gross margin on Palantir is like 85%. Adobe, 90%. These are all software businesses. that make a ton of money and are growing like crazy. This is expensive. Even if it's not a car company anymore and you think it's a software business, it's still expensive. That's the problem we have. That's the real problem. Let's look at the 8 pillars. No idea what it's going to look like. Not bad. 5 checks, 3 X's, some slight, dilution. But look at these price to free cash flow and PE ratios. Analyst estimates. Big growth in earnings per share from $2 to $11 per share in the next 4 years. And revenue growth, 9%, 16, 15, 47, 32. A lot of revenue growth potential. And they're able to expand into their areas where they have higher margin. Not bad. So let's run our stock analyzer tool here. Let's pull up Tesla. The last time I did it, 10-year analysis, 7, 11, 15% revenue growth, profit margin and free cash flow margin of 4, 6.5, and 9. Now, keep in mind, this is kind of like the car business side of it, not the software side. Because remember, guys, as much as I like Elon, he misses every single goal he sets. And the whole idea of selling software as a service and as a monthly subscription hasn't worked so far. The self-driving was $12,000, then it became $8,000, then it was $99 a month, and then it became free for 3 months or 2 months, and less than 2% of people signed up for it afterwards on the monthly subscription plan. It's a little hard for me to get my head around. 15, 18, 21 PE and a 9% desired return. Hit the analyze button. I have a low price of 22, high price of 115, middle price of 54. To tell you that I do not think this is a good value is an understatement. But by all means, you probably see something I don't see. Let's make some assumptions about the revenue being better with higher margin because of humanoids. I'm increasing my profit margin to 10, 15, and 20%, my growth rate to 10, 15, and 20% as well. Hit the analyze button, still overpriced. 70 on the low side, 375 on the high side, 170 in the middle. It's still overpriced. Guys, I'm apprehensive about that. So let's pull up another stock that I own that has shocked the world in its returns in the last year, up 90%, outperforming, I believe, NVIDIA. The next stock is one of the most iconic names in the history of technology, Intel. But for the better part of the last decade, it has absolutely fallen behind, losing ground to competitors, fumbling its manufacturing, and watching rivals like AMD and NVIDIA eat into its market share. Then something shifted. In 2025, Intel stock surged over 80%, and investors started asking whether one of Silicon Valley's original giants is actually staging a real comeback. But notice what I said there. The stock surged, and then people started asking. News follows the stock price. That's the big key there. The rally started with a change at the top. In March of 2025, Intel brought in Lip Bhutan as its new CEO, an industry veteran who came in with a clear message. The days of sloppy overspending were over. He cut costs, he laid off workers, and he refocused the company around financial discipline. That alone gave Wall Street reason to pay attention again. But what really got investors excited was the money that started flowing in from powerful backers. The US government took a 10% stake in the company through an almost $9 billion investment driven by national security concerns about having American-made chips. NVIDIA put in $5 billion, SoftBank added another $2 billion. On the technology side, Intel scored a meaningful win by successfully launching a new chip called Panther Lake, built on its most advanced manufacturing process yet, something called 18A, which refers to how incredibly small and efficient the chip's company components actually are. This matters because Intel's manufacturing struggles were at the heart of its decline, and proving the new process actually works was a critical, huge step. And now, we are hearing reports that Intel is producing custom chips for NVIDIA and Apple, which could be a huge validation that its factory services can compete with the world's best chip makers again. So where is Intel trying to go from here? The big strategic bet is turning Intel into a company that manufactures chips for other companies, similar to how Taiwan Semiconductor makes chips for Apple, NVIDIA, and others. Intel wants to be the second largest chip manufacturer in the world by 2030. That's ambitious, but the government backing and early customer wins suggest it's not just wishful thinking. Beyond the factory business, Intel's pushing hard into AI. Its Gaudi 3 chips are being positioned as a cheaper alternative to NVIDIA's expensive AI processors, and the company is aiming to have 100 million AI-capable personal computers powered by its chips in homes and offices around the world. The honest reality is that Intel still has a long road ahead. It gave up years of ground to competitors, and rebuilding manufacturing leadership takes time, money, and near flawless execution. But the combination of focused new leadership, billions in government and corporate backing, and new chip technology could make this an amazing turnaround story. And what I love the most is when it fell to $17 a share, we said on this channel, like, at what point is somebody just going to buy them? And sure enough, the word started spreading that people were looking into them. At that kind of cheap price, with that kind of reputation, it becomes an easy acquisition for some big company who just wants to take over the business. So for this company, guys, the numbers are shit. Negative free cash flow, net income's down, revenue is down, everything is terrible, profit margin's awful, but it's all about what it could become in this situation. So let's go take a look at the 8 pillars. You want to guess how it looks? All 8 are X's. I own the stock. Again, don't buy it because I have it. Analyst estimates. Now, here's where it gets interesting, if they're right. 50 cents a share this year to $4 in 4 years. That's a lot of growth. A lot of growth, and with revenue growing and climbing back up to all-time highs, 55 billion to 77 billion. Guys, this will take time for a company like this. Absolutely. But let's go put it in our stock analyzer to see if it happens, what it could look like. So this is a 10-year analysis. Now, again, I want to repeat till I'm blue in the face. Intel is a long turnaround story. It was hard to keep Intel into the teens. Not going to lie to you. Yes, I'm in the positive until right now. I started buying it at 55, went down, went back up. I lost the covered calls, went down, started to get it. At the end of the day, guys, all I care about is what does it look like from a stock analyzer tool perspective. I did 4, 7, and 10% revenue growth for the next 10 years. I did profit margin of 12, 16, and 20. And keep in mind, that's actually lower, even on the high side, than they were doing before their big fall. PE, 14, 17, and 20, and my desired return of 9%. Hit the analyze button. I want you guys to keep in mind, when I started buying it in the low 30s, as it went down, it's a lot different situation than $43 a share. Because look at this. Low price of 20, high price of 68, middle price of 39. That's the difference here I want you guys to remember. Different price, different projected outcomes. That is the key. The more you pay, the less you earn. Guys, according to our community ratings, Palantir is rated as the highest seller on our entire platform. And a lot of analysts also believe that Palantir is the most overhyped and one of the most overvalued stocks in the market right now. Now, if you're like some of the investors out there that bought the company without knowing what they do, Palantir is a data and AI company that works primarily with governments and large businesses, and the stock has been one of the biggest winners of AI boom. I hope you caught that dig in there because it was meant to be there. But as of early 2026, the stock trades at over 100 times expected earnings and sometimes closer to 200 times earnings, meaning investors are paying an enormous premium for what the company actually earns right now. To put that simply, imagine paying $400 for something that earns you $1 a year. Some analysts have described it as a stock price for the year 2035, meaning it only makes sense if Palantir completely dominates the AI industry for the next decade, with earnings growing over 200%. The company also pays its employees heavily in stock, which quietly dilutes the value of every share that you own as an investor. And in the commercial market, it's starting to face stiff competition from giants like Microsoft, Snowflake, and Databricks. If enterprise AI spending slows down, or companies stop experimenting with AI tools, stocks priced for perfection like Palantir tend to get hit the hardest. To be fair, Palantir's US commercial business grew 137% in late 2025, and there are serious analysts who believe the platform is the real deal long term. But remember, I can believe it's the real deal long term, but still think it's overpriced. Our community message is very clear. At this price, you're not buying what Palantir is today or even what it's doing in the future. You're paying a very high premium and price for what it might become someday and more. So let's go look at the numbers ourselves and see if we agree with the Everything Money community. Guys, Market cap, $366 billion, great balance sheet. Enterprise value is lower than market cap, which means they have cash on hand. Cash flow was $2.1 billion last year. They're selling for 175 times free cash flow. Profit margin, 36% last year, 11% over the last 5-year average, so it's getting better and better. Gross profit, 82%. Revenue growth, 30% a year. Returns on capital, getting much better. Guys, if I just saw everything but the price and the valuation metrics, I'd be like, this is a beautiful company. Let's go check out its 8 pillars. Dilution City, 28% dilution. Why? Because they're giving out shares to, and by the way, go Google how many insiders are buying. 0. Alex Karp, who sits there and gets mad at everybody out there and saying, oh, we're a great company, he keeps selling more and more shares. And you might sit there and say, well, it's for diversification. I get that, but what's his diversification? Guys, let's see what analysts think. Earnings per share growing from $1 to $3.29 in the next 4 years. Pretty solid. That's well into 30% growth a year. Revenue growth, 41, 38, 35, 42, 40% revenue growth for the next 5 years. Now, guys, not going to lie to you. Putting it all together, I'm not going to make those assumptions. Why? Because it's just hard for a company to do that, especially a new company to AI, in the sense of this company's been around for a while, but AI is a new area. So the question becomes, can they still dominate for so long? So let's check this out. I did a 10-year analysis. 12.5%, 20%, and 27.5% growth rate. Profit margin, 35, 45, and 55. PE, 18, 22, and 26. Guys, this is all good premium stuff. Yes, it's not as high as the next 4 or 5 years on revenue growth, but I just have a hard time with it. My 9% desired return. Hang with me while I do some more assumptions after this. But look at this. Low price of 21, high price of 140, middle price of 56. It's basically worth its current price if all the highest assumptions come true. So let's go in here and change that revenue growth to 20, 30, and 40%. It's still not making sense at 30% revenue growth a year for the next 10 years. That's what's scary about this business. And guys, it's down a lot from its high. Its high was what, 210, 207 back on November 3rd, just 4 months ago, and now it's down to 143. So guys, if you want to see companies that actually fit my process right now, I actually picked 7 stocks last year to go against the Magnificent 7. And I'm going to be honest, the results were not what I expected. You're going to want to see how things panned out. So you can click on the video right here to check it out. Thank you for your time.